All right, we're live.
Good morning, Canada.
I always get so pumped up like the 30 seconds just before Mr. Stephen Rochester in the back end there tells us we're about to go live, and then you see this thing on your screen. You're about to enter live. I feel like I'm about to hit a massive stage, and it doesn't. It's so cool. Lacey, most like it doesn't matter how many times we've done this brunch, which is coming up to what's 3 times 50. So we're about 150 brunches now in. Countless in-person events for the last 17 years. It doesn't matter if it's 7 people or 7,000 people. Like I still get those butterflies. I always laugh with the team at the headquarters. I'm like, the day that stops for me, that's it. I'm like I know that I'm not excited anymore. And it's so cool. Even like when we're meeting with we're doing our one-on-ones at the office with our REC insiders that come in to do like a real estate action plan or just talk about their property. I still get that. Like, this is something that we've been doing our whole life, man. It's so cool. But as you were welcoming everyone, again, it's Jazz Taka. I got my boy, my brother from another mother, my business partner for 17 years now. I can't believe, look, you had a lot more hair. I guess I did too. Mind you, I do this on purpose. Yours is not, but let's just call it what it is. Mr. Simeon Papa Elias, aka Simos. What's been happening this past couple of weeks, man? Because we haven't been on since June. Tyler, our boy, has been doing his real story segment. Our guest today. So before we even get into like how our past couple of weeks have been, I'm kind of fanboying. I'm gonna be honest. Like this guest today, when as you and I were doing our lineup for the first half of the year, we said we gotta get this guy in. He's coming in all the way from British Columbia, so it's extra early for him. But I know he's an early riser. But to have someone of his ilk, of his credibility, of his experience, he leads the biggest real estate investment group in Canada. I'm going to venture to say it's probably the biggest one in North America, which then probably leads to it being the biggest one in the world. You guys are majority of our REC insiders are either part of this group or they definitely heard of RAIN, the real estate investment network. And we have the CEO joining us today, Mr. Patrick Francey. Like, we've had a lot of people who know what the heck they're talking about when it comes to real estate stats and forecasts. But this guy, the way that he explains it and dissects it and all that, like, so it's going to be really, really cool to be joined by and joined with Patrick Francey to just go on, just to speak about what's going on in the market.
Yeah,
But
man.
why don't you touch on, brother, like what's been going on the past 3-4 weeks, man? We've been
Well,
really
first and
busy.
foremost, I definitely share the same sentiment. I'm very excited to have Patrick come on. I've been on a couple of events with him in the last 30, 60 days or so on his stage at the Rain events. And the man in his entire organization, and he'll be on in a minute. I don't want to, I'll save it for when he's here. But JG, Francoeur, Patrick, their entire back end team, their research department, what they're known for is real estate research. They
Data.
supply real estate investors with factual data. So we are going to speak to it when he's on. So I'm going to kind of stop there. But the market's been in the funniest place in a very long time. As a matter of fact, it's the most interesting time in our careers that we've seen, just because of the cocktail that's been brewing. The market is in a very, very good place. Some people beg to differ, and that's fine. I'd be happy to argue any fact. But I've been, you know what? Let's bring Patrick on because I know he's in backstage now. Let's bring him on board because I want him part of this conversation. Because what I'm seeing, I want him to. Yeah, let's get his take on as well. Because I know you're live on calls with our actual clients, the guys and gals buying real estate. I'm on the ground with 50 of our team in their interactions with guys and gals buying real estate, investing in real estate. And I'm speaking also to our our strategic partners. So as I get a lot of opinion, and Patrick, good morning.
Good morning.
Welcome to REC Live.
Sure.
Um,
It's brunch with REC. And Patrick, if you were in person with us, just so you know what you're missing out on, we would have a massive array of food. I'm talking about like
Yeah.
eggs and sausage and bacon. So we cannot wait. We cannot wait to host you in person whenever that is. It might be
We're almost there.
3 months.
We're almost there.
It might be a year from now, whenever it is, Patrick. And Simos was mentioning like what's been going on in the market.
You asked me what's going on, and before
Yeah.
I share what's going on, what I've been seeing, I wanted you to just hop up here and hear what I'm seeing, and maybe because we're in the East Coast of Canada, you're on the West Coast, maybe there is some differences, and maybe there is different sentiments across the nation. So I'm definitely interested in getting your insight on this. So what I'm seeing, to answer the question, Jazzy, is at the end of May, the market was overwhelmed with fear. Fear, misinterpretation, no interpretation, and the instant market reaction of every human being, bar none. When you don't know what to do, you do nothing. We saw everybody clamp down, clam up, and watch as the media took its turns and doing all the things that really are irrelevant. Out of the newspapers, I can truly say that less than 50% is tied to fact, and the rest of it is sensationalism to push sales and do the things. They always include the truth, but the interpretation in the headline, which is what 80% of people actually get because they don't have the time to dig deeper, they just look at the headline and that's their opinion. And that's wrong. So I saw fear, I saw misinterpretation over the last 45 days. So since mid-May to today, I'm seeing a massive amount of sentiment rebuild up, meaning people know interest rates are going up, and they're going up for more than one reason. So buyers are starting to take action again, knowing that if they wait for, or if they're inactive because of fear, they're going to pay for it later. And that's with real money, real net dollars that they have to earn. So we are seeing a return of most buyers into the marketplace. And I am seeing my agents in multiple offers daily on rental. So all those 2 to 4 year agents, those junior intermediate agents that do 80% of leases in the city, are literally competing every night for their rental clients. Why? Because they can't qualify to buy under the new rules. So that's what I'm seeing. I'm waiting, obviously, for mid-July's Fed announcement. That I have, I'm counting the sleeps basically, because I need to see what happens. So with that, I'll leave that right there. Patrick, give us your insight, my man. What do you see?
Well, when you look at an overall market, here's the thing that's been going on the past couple of years, which is, all boats rise on a high tide. And when we look at a national picture of what was happening, even into the US, all boats are rising because, real estate was going up, just going up, going up. That was kind of the thing that was happening. But the reality of it is that now that we're back into what we would call real estate normalcy, I could put it there, which is real estate's regional. Full stop. Now, all boats are not rising on a high tide. Tides are coming in at different paces and the way they should. And based on what is driving real estate is always the economic fundamentals, and what's happening regionally in Alberta or British Columbia is different than Saskatchewan, is different than what's happening in Ontario. And so we have to look at the market through a different lens than we have been the past couple of years. I mean, that was past 2 years has been an absolute anomaly.
Yeah, free money.
Exactly. And it was driven, and you can get into the politics of it and monetary policy and the printing and all the things that they talk about. But ultimately today, what we're seeing is now a shift in what's happening economically. We know that affordability was based on, I can't afford this house. It's too expensive. And now it's affordability. Well, the price has come down, but the interest rate is up. So my payment is actually higher than it was before. And all of a sudden there's another shift in the market driven by what is looking like, an increase in interest rates. So a couple parts to it. Number one is if we're speaking to home buyers, somebody who's buying a home, that's a different conversation than if we're talking to an investor, because investors have a different agenda. Then we have to look at, and my focus is always working with investors and investors.
And Patrick, I'll just tell you right now, the audience you're speaking to right now, I would say is literally 90.
Yeah, 95%.
Investors. So homeowner, you are being let free, meaning if you're buying a home for yourself, literally we have nothing to discuss. You're good. Buy your home.
Yeah.
Because you're living in it 5, 10, 15 years. No discussion, full stop.
Yeah.
Now stay on and learn what it's like to be an investor, somebody who profits off bricks and mortar or is looking to profit off bricks and mortar. Patrick.
So then it always boils down to, as an investor, what's your plan? I mean, why are you investing? Why do you want to buy that piece of real estate? What's your exit strategy? How long do you intend to hold it? Like, what is your overall, overarching plan? Is this going to be an assignment because it's a new build or a pre-construction and you intend to hang on to it and then assign it or sell it? Well, what is the plan? That's ultimately it. But behind all of that, whatever that might be, I only look at, I shouldn't say I primarily look at the economic fundamentals that we know drive real estate. And then I look at whatever the specific region is. To your point that you made earlier, when it comes to affordability, we are bumping into that challenge of affordability. We've been telling investors for, a year and a half now that this will come. And now what's happening is people can't afford to buy. They're driving the rental market. So guess what's happening? We have an increase in rents happening right across the country, varying degrees. We've got high immigration. And some people don't really realize this, guys, is that, when it comes to immigration, we see the demand for rental is higher, but also within that is when immigrants come into the country, first off, they don't know necessarily where they want to live, but most land in Toronto, Vancouver, or Montreal. That's primarily what happens. It takes them at least 2 years, sometimes 3 years before they find a place that they want to own or can buy. They don't have a credit rating. They don't know exactly where their job is or where it's going to take them.
And they need some stability. They need to create a home.
They do. And then culturally, they don't go, well, I don't know what part of the city I even want to live in. I want to hang out with my people. And so I don't know. So guess what they're doing? They're renting. So when we understand the dynamics and our political environment and our government driving immigration, which for Canada is a necessity given we're not having more babies and we're getting older, hence me, the reality of it is we need that immigration. So the demand for the rental market is there. We know that we're going to go through some really crazy economic times in coming up here and as we go forward, but it doesn't stop us from investing. The key is to have a plan, know why you're buying it, and how you're going to exit, what your plans are in that regard.
Now, Patrick, we mentioned that I'm going to say about as high as 95% of our audience that are watching live right now, as well as a little over 11,000 people that the email is going to be sent out to of the recording, are investors. But within that, we have investors that are still looking to invest into their first property. They haven't even figured out what type of strategy they might even use and actually invest into. But then we have people who are, majority of our guys and gals are probably they have 3 to 5 doors. And so the reason I mention that is because, you've been in this real estate world for, I'm not going to age you because you still look really good for your age, whatever that age may be. But you've been in educating, not only educating thousands upon thousands upon thousands of people, but you yourself are an investor. And so if we can just take it back a little bit, because I think I personally would be remiss if I didn't use this time with you to at least let people be a fly on the wall of the conversation that we're having in taking it back to real estate 101, meaning some of those fundamentals, those economic drivers that you spoke about. Can you just elaborate on that? What are the 3-4 things? It might be just one that you really hone in on. Can you just touch on that a little bit? And to that person that has, even the girl that has 3 properties, they might have just stumbled onto that. They were thinking about selling their principal residence. They bumped into me. They bumped into CMOS. We begged them not to sell that property. We taught them how they could keep it, refinance it, and then buy another property to live in. So hence, like, they just kind of fell into that income property. But as an investor that's starting out or going to get their third or fourth, eighth door, what are those fundamentals?
Okay, so that's a great question, Jazz. So, first and foremost, we have to look at the economic fundamentals that drive real estate. Now, these don't ever change. They don't go away. This is what drives the economy, and it's what drives real estate. As real estate investors, what do we want to do? We want to look into the future. We want to say, where's real estate going? Not look at where it's been. We want to say, well, here it is today. Where's it going? So we have to consider what we call, what everybody's familiar with the term GDP, okay? Gross domestic product. We watch that number, but a lot of people don't know why we watch that number. Well, GDP, if we just want to break it down into its simplest description, it's an economic snapshot of a region, of a country, of a province, of a city. So when we have positive GDP, it means that we're producing goods. There's money churning in the market, things are happening, and the velocity of money. We have the flow of cash going on. And when you have positive GDP, what have you got? You got positive employment. And now this is where we get things regional, and I'll give you an example of it. And just to be clear, so when you have positive GDP, you've got jobs. What do people need to do? They need to work. So wherever the GDP is really churning, then we start to see jobs. Then we're going to see immigration or interprovincial migration into the region where those jobs are. That's
exactly what we saw in the mid 2000s going on. Like half of Canada moved into Alberta with that oil boom. Right. And then they moved back to where they came from, and now they're moving back the cyclical market of energy.
Precisely. And so when you have jobs, you have, like I say, immigration, interprovincial migration, and then what happens is, of course, they move into that region and they're renting. So you start to see rental demand go up, you see vacancy rates come down, then of course, supply demand, rents start to increase. And then usually, and all of this, by the way, is usually from the time you see positive GDP to the time you start to see price increases, about 2 years. Because it's a cycle, right? And it takes time for all of this to unfold. So I want to just point out here is that on the reverse of that, you see negative GDP, then you start to see jobs go away. You start to see people move out of that region. You start to see the vacancy rate go up. Then rents come down, supply demand again. Landlords are going, rent me here, I'll give you a deal. And then that's the reverse cycle. Again, from the time you see a negative GDP number to the time that all that, prices come off, et cetera, is usually 18 months to 2 years, actually. So the point is that when you're looking at those economic fundamentals, it is a crystal ball into the future, but you have to pay attention to it. You can't just wake up one morning and go, oh, holy, everybody's leaving the province. Well, okay, no, there was lots of things prior to that.
What I've noticed, sorry, go ahead, Jess. Go ahead.
Go, Simos, go, buddy, go.
What I've noticed, which really actually aggravates me, is most, I'm going to say this, it's a generalization, but I have to because it's most of the brokers, and I mean real estate agents and mortgage brokers that I speak to and interact with every day. If I hear one more of them say, oh, no, wait till the fall, everything's going to be okay. I have never seen so much blind ignorance in my life. Oh. I can't stand it.
Dangerous.
Yeah. Like literally one of my biggest, other than doing REC, my whole Broker's Playbook podcast, which is an industry-facing podcast, all the work I'm doing with that is like, wake up. Yeah. Like here we're speaking to our investors, and it's the same message. But most of my investors are actually fearing the opposite, as opposed to having these little rainbows on the side of their eyes. The agent hasn't adjusted to be like, it's been so good for so long, where they think, no, it's just going to correct itself magically. Don't even think about it. By the fall, everybody's gonna be okay. Listen, idiot, stop it. We are in a real situation. It's not a bad situation. It's a situation. It's cause and effect, and we have to deal with the repercussions of printing money. That's all there is to it. Immigration is flowing in Amazingly, it's our actual lifeline. That is what we're going to hang on to be able to progress. God bless. But as you said, the immigrant coming in needs a place to stay and they need to find their footing. Rental market's going to boom. Right now, to all my investors in this audience, rejoice. Your rents are going up. Your cash flow is going up. Be very cautious with everything that you think about, but don't be optimistic for the sake of being optimistic. I'm optimistic because I believe in the fundamentals of real estate. All of them. So I know as a fact that all of you and me as an investor are going to be not only okay, we're going to make more money than ever between now and the next 5 years, factually. More money than ever. But when I hear a broker say, well, just wait till the fall, what are you referring to? We're about to get 2 more increases at the very least. Things are going to get a lot worse for the first-time home buyer, for the seller who bought in the last 6 months and will need to sell in the next year. Not long-term fundamentals, but the short-term fundamentals.
Well,
and that's what
those. Oh, sorry, Jez. And just to give you a couple of quick examples, right? So you talk long-term fundamentals, which you talked about: GDP, immigration, job growth. Those are kind of the fundamentals of what runs an economy. But there's the influencers, which you're talking about, which is interest rates is an influencer, politics is an influencer. Influencers are shorter term. It's not that they're necessarily short term, but they are shorter term. And so fundamentally, when you talk about those brokers that are saying, just go blindly forward, here's the fundamental around it. Interest rates are a influencer, but that doesn't mean you shut everything down, because again, when we go to affordability and first-time home buyers not being able to buy a first home, they're now renting. All of these things are starting to happen. But here's the thing that we all need to consider when we're looking at this. As I said, we have to look specifically at the strategy before we can actually make decisions. So in other words, we say it time and time again. I know you guys say it: buy for cash flow, buy for cash flow, buy for cash flow. If you're into a buy and hold situation, right? There are times where you should flip and there's other times that you should not flip. So make sure you're using the correct strategy, as opposed to, okay, sit on the sidelines and wait. That's a mistake, because you're going to miss a ton of opportunities, because there's a lot of opportunities coming up.
Patrick, going back to Jazz's question, what is, and this goes to everyone because it's the one fundamental, and it's going to be surrounding buying and holding, but can you take us through, in your words, that no matter the times, no matter what, the one strategy for everyone that can be implemented easily into a buy and hold? Explain a buy and hold in your words. What should that deal look like?
Well, when we look at a buy and hold, whether, I'm not, because, okay, so I'm going to use this example. I look at a buy and hold, and I'm going to look at a single family unit, right? Now, a single family unit isn't going to cash flow. Well, why not? Because, well, there's just not enough income. You're going to have to turn that into a duplex, triplex. You're going to have to look at, how can I add revenue to, buying that particular property? So when I talk about cash flow and buy and hold scenario, I'll look at a detached bungalow, for example, duplex, triplex, whatever I can turn it into. And then I'm going to look at what are the sources of revenue that are coming to it. And do I have the opportunity to increase that revenue so that, it's going to cover, principal, interest, taxes? Is it going to cover insurance? Is it going to cover property management? And then still come out the other side on top of it. Do I have the opportunity, because I'm into a region? Sometimes we can look at a region, like I'll look at Alberta, for example, right now. Like, I know that market very, very well. And and as much as we see rents where they are today, given what's happening economically in Alberta, we know rental rates will start to come up over the next year and a half. So we can say, okay, well, if I'm only cash flowing $100 a month, I'm pretty confident that I can grow into another $100 a month, or another $100 a month, whatever that might be. So I don't know if that answers your question, but
yes, it does answer my question. But fundamentally, we talk about buy and hold as a strategy of growing wealth. We're not into day trading. Real estate will never be something that we speak to as day trading. And speculators always learn their lesson in rapidly changing times. Yeah. So any speculator out there who thought that the show is just going to go on with that blind ignorance, let me tell you, when you have a 300% increase in interest rates in 90 days, welcome to the show, bud.
Yeah.
I wanted to actually
It
just
comes out, we see who's swimming naked as the
Yeah.
as one of the biggest quotes of Warren Buffett of all time. Let's go.
I wanted to also continue the conversation on, like, when you started to mention GDP and you spoke about what happens when you have the positive GDP. You touched on with the negative GDP, but a word that we hear a lot of around here right now is the word recession. And for anybody that doesn't know, once you have 2 consecutive quarters of negative GDP, that's the actual definition of a recession. What are some strategies, and what have you seen in the past, Patrick, that people can win when heading into a recession when it comes to investing into real estate?
Yeah, great question, by the way. You talked about many of your clients, they own that 2, 3, 4, 5 properties. I've been through 3 or 4 recessions in my life. And
hence why we wanted to have you on, right? And really quickly, just for anybody who's just joining us, we are joined by none other than the CEO of the largest real estate investment network group, education network, RAIN, Patrick Francey. So I just wanted to bring everybody up to speed, but continue on, Patrick.
So, yeah, well, thanks. So when we look at what so for example, as investors, we have to look into the future and whatever decision you come to. So for example, there's lots of talk about a recession. Okay. So we see a future recession. There's so many global dynamics happening, everything from increasing interest rates to food shortages to the meltdown of Europe and UK, and how does that affect us? Of course, China, are they going to go to Taiwan? Is Russia going to continue to partner? Like, there's so much going on in this world. It can be really quite frightening. So let's say in your world, whatever your world is, by the way, you say, know something, I think there's going to be a recession. Okay, great. So if you're going to anticipate a recession, then you put your plan together. So I can tell you, if I'm looking into the future and seeing a recession, what am I going to do today? The future is now, right? So what am I going to do today? Well, first and foremost, I'm going to make sure that the tenants that I have in place, I'm going to have a conversation with them. What's your plans? What are you thinking about doing? Are you considering moving out? How about if we extend that lease? So I want to make sure that my leases are extended. I want to make sure my tenants are satisfied. I want to make sure that if I'm over leveraged, I want to go, okay, how can I shift this dynamic? So number one, I'm not over leveraged. Number two, I have access to liquidity, because at the end of the day, it's all about cash and it's all about being liquid. This is not the time to be over leveraged. This is not the time to be pushing it to the wall in terms of what you're doing with capital. You need access to capital. I can tell you, only by good fortune, probably more than good planning. That's what we got my partner and I through 2008. I mean, it was absolutely
shit show.
Patrick, I know this is going to be like different for everyone, yeah. But what, like, when you say over leverage, how much cash, like, should somebody have? Like yesterday, I felt it. I went to Tim Hortons and I couldn't use my debit card and my credit card. And luckily, I know it's on a much smaller scale, but luckily I had a toonie sitting in my car to just get a coffee. Otherwise, I was going to ask the guy behind me to pay me and I'll get him later kind of thing. But we felt it yesterday, right? Like on a smaller scale, everything was shut down. Like, and this is not about crypto. It's not about stocks, but I couldn't get to any of that money either. But in terms of over leverage, to my guys and gals right now, like, is there kind of a percentage that you would say, look, try to at least keep this much of your net worth in cash in your bank account under your pillow, even if it comes down to it?
I don't think there's a specific number per se, but you gotta anticipate that if you get a vacancy, you could be easily 3-4 months in a recession. You could literally be 3 or 4 months before you actually can get that property rented out. So can you carry that asset for that 3 or 4 months while you find another tenant? And the other thing is that you want to consider is, if you have to drop your rent, are you going to be able to fill that gap if you happen to be upside down, depending on when you bought and interest rate, et cetera, right? So if all of a sudden you're upside down $200 or $300 a month on cash flow over five units, the next thing you know, you're upside down $1,500 a month, $2,000 a month. Can you carry it for 3, 4, 5 months? These are things that we have to consider when we're doing that. And of course, what happens if one of the units that you have, and oh gosh, I blew a furnace, hot water heater. Of course, through recessions, anything that can go wrong will go wrong, and you just really need to have access to capital to handle those situations.
I mean, and I love what you said there. I mean, Simos, and you and I mean, we lived it in that first probably 4, 5, 7 days after the lockdown, and people were saying that we were going to go into a recession rate. At that point, we never did. However, the first thing that you and I did and said, look, honey, not me speaking to you, me speaking to my wife, and I'm sure you did the same at home, we might need to stop with the organic strawberries. I mean, the kids will survive, and let's just get them the regular strawberries. How much access do you have on your line of credit, Simos? How much, like, can we bring down some of our costs? We, knock on wood, kept every staff member. However, we needed to, like, take a step back and look at our financial portfolio and look at where can we get access to cash if we needed to. And so, I mean, your point about, Patrick, your point about getting ahead of the curve and being proactive, I mean, that's a reminder for everyone who's watching and listening right now that has a tenant. And that's something that we're going to go back and do right away, right across all of our properties, is make that call, that phone call to your tenant. I mean, I think that's a very, very tactical thing that everyone can take. Very easy to do. Hopefully you're in touch with your tenants anyways on a regular basis, but at least you can give them a call and just see where their headspace is at. And I think that's the question, right, Patrick? Like, hey, Mr. and Mrs. Tenant, where's your headspace at? You thinking of staying here longer? And kind of going down that path so you can start to forecast and budget a little bit better.
What I'm going to put a note on, boys, is what Patrick just said. I spent 5 years in my mid-20s, right before I got into real estate. I had spent 5 years in finance, and that was in the default space, small business defaults. I worked with the Canadian Imperial Bank of Commerce in running their small business portfolio, both privately and contingency, which is another name for, I guess, a collection agency. It's a third-party contractor who regulates portfolios. And overwhelmingly, when I spoke to people and they asked for advice, as you grow in that space, and I finished up being an AVP for the company, what happened as a finance expert, you have to be able to give advice that can resonate with everyone. To resonate with everyone, you have to look at who you are. If you only have your primary residence, you need to be liquid enough to carry your property for 3 to 6 months if you were to lose your job. If you're an investor and you have your primary residence and you have, let's say, 2 properties, you can count on at least one of them being vacant for 3 months. So can you carry your own household if things were to fall apart while carrying the second property for 2-3 months? If you have 5 properties, can you carry 2.5 properties for 3 to 4 to 5 months? If the answer is no, we need to sell one, bring the LTV, the loan to value, down a bit, yes, and be in a more secure position. Meaning you're going to play defense for a couple of years to ensure that you don't jeopardize losing your roots. You don't jeopardize the home. So if you lose a property instead of gain 2 for 2-3 years, you're not losing anything. Your existing portfolio will carry you with security and stability. What you don't want to do is risk of being derailed completely and the wind blowing your roots out of the ground. So that's the advice, like taking Patrick's advice of having that nest egg, having that security. Easy way to look at it is the bigger you are, take a look at what it would take to carry half to 70% of it if something were to happen. And if the answer is you wouldn't be well, if you would turn green or not sleep at night, get rid of one, take the leverage down a bit across the portfolio until the answer is I would be able to carry the balance.
Now, you said the word defense, and I mean, we just spent a good 13 minutes on speaking about that. We also know on the offensive side, and I just want to get both of your takes on this, that recessions create a lot of millionaires and billionaires as well. It's just sometimes we don't know in which sector it's going to do it, right? Like if you look back.
No, but Jazz, buying in a recession is playing defense. But so it sounds like offense. If you truly think about what you're doing, it's the counter. So it's when you draw back just to push forward. So saving and securing yourself, I don't want it to be confused with squandering opportunity. So I want you to go hard on your point, because buying real estate during this time is probably the best thing you can do if you can do it.
Well, actually, here's the take that I really want to get from Patrick as well. I know it's Brunch with REC. REC stands for Real Estate Center. We are very biased in and around real estate, but we're also investors, all three of us, and we're trying to create wealth in a lot of different ways. And I think that's very prudent of us. But if you look back at, like, say, 2001, I mean, out of that tech bubble, we saw a lot of people make a lot of money coming out of that recession. In 08, you saw it as well. What is your thought right now, Patrick? I mean, in 2020, we thought we were going to go into a recession. We never did. But if we, it's safe to say that we're going to probably, one's coming very, very soon. Is it real estate? Is that where the wealth's going to be created? Do you see anything else out there possibly? I just kind of want to get your thoughts around that.
Oh boy, it's a pretty big question. So I'll just try and keep it really short. I'm still a big fan of real estate. And I don't want to step over one thing, back to defense, offense, understand something. And Simeon, you said it earlier, which is, there's speculators that have been, everybody's getting rich. Everybody's a freaking genius when real estate is like this. We've all been through those markets. I'm a genius. I'm a real estate genius. I made $300,000 on paper anyways, right? So
you could have bought a parking lot in Toronto 10 years ago for for 25,000. It's worth 200,000. Everyone is a genius in those.
Yeah, everybody's a genius, right?
Yeah.
So there's a couple parts to it, right? So we're talking about investing, not speculating. So number one, hopefully we've done some things right to begin with. Then we talk about risk mitigation, which is going forward. How do we see it? Well, all of those speculators are not having these conversations right now. They're freaked out. They don't know what the hell they're going to do. So the opportunities in real estate are going to come from the speculators who get flushed out. The guys who made the mistakes, the guys who are going, holy shit, I can't afford to carry this. Oh my gosh, real estate.
It's the geniuses.
It's the geniuses, right? So, that's going to create a lot of opportunities for us. With what's happening globally, back to your, Rogers shutting down and, it's whatever the reason was, cyber attack, no cyber attack, it doesn't matter. So when we look at risk reward and then we look at, when we weigh the cost of doing something. So for example, you happen to have a toonie, so you're able to grab some cash. When we look at what's happening globally, we have to say, where can we put capital to get a return on that investment? Real estate is absolutely one of the answers to that. But when we talk about risk mitigation, a conversation that you want to be having with your tenants, for sure. And guess what? They're feeling the pressure. They're feeling the pressure of an extra $300, $400, $500 a month food, an extra $300, $400, $500 a month fuel. I mean, they're feeling that pressure, and you need to be having those conversations with your tenants. 100%. Do it diplomatically, but listen to them, have some compassion, and understand that whether it's them or the next person you put in there, this is going to be something that starts to show up. So be really aware of that. Having cash, by the way, Jazz, just, what is the downside of having 6 months of living expenses in cash tucked away in a drawer or a safe somewhere, right? Should hit the fan totally. What's the downside of having a few $1,000s in precious metals, as an example? These are all risk mitigations given what's happening in a global world. But when we look at real estate, people will need, number one, the whole world isn't going to shut down. All of a sudden, nobody's working. There's going to be jobs. There's going to be immigration. There's going to be a need for people to live. And real estate is always going to be something that we have put our capital into and get a return on that investment.
And I am going to stress, Patrick, what you just said. What's the hurt in having some money stashed away in cash because something happens? For those who have never lived in a place on earth where things happen rapidly, yesterday in Toronto, Ontario shut down. So things can happen rapidly anywhere. Yeah. I'm also of Greek heritage, which I moved here in 1995, but in 2012, 2015 to 2017, when the Greek economy, the bottom fell out, you couldn't get more than 200 euros, my friends, out of an ATM. You were not allowed in the bank because people would have gutted the economy 15 times harder by taking their money out. So to have some cash stowed away, and do not think we're talking doom gloom nonsense. I'm not talking about digging a bunker in the case a war happens by any means. We're talking logical, real life planning. As
Seamus,
an investor,
where's your gold bar hidden? That's all I want to know right now. Where behind you is that gold bar?
Plural. It's Simeon. It's gold bars.
It's plural, right, Patrick? Well, there's something to that, though, right? Like
100%. But Patrick said precious metals. Why can't, like, if you are looking to diversify, because that precious metal bar in a market like this goes skyrocketing. So you always have something, a little bit of something that you never know that it pulls you, what hole it pulls you out of.
Yeah.
So to have these things, if you don't know where to start, get the appropriate advice. Again, we send emails all the time to our entire audience, asking anybody who needs a real estate action plan to reach out. Mm-hmm. Where we get our advice from is we have podcast recordings, conversations, and masterminds with people that are much smarter than Jazz and I, like Mr. Patrick Francey.
That's why we bring up Patrick. Hey, that's why we bring up.
So we're very happy. So we're very happy to pass on some good advice, guys. Whoever needs it, go to reccanada.com, book your REIT. Tyler and the team will get back to you. You can reach me. You can reach Jazz. Well, maybe Jazz is too cool. Who knows? But you can definitely reach me.
I do have a question for you, Patrick, and please, like, feel free to, like, just kind of go off on this. Like, I don't know which way, like, you kind of lean in terms of the word inflation and how they could possibly curb this. Like, what's your opinion and what's your thoughts on what's happening? I haven't seen this ever myself before. I'm 40 years old right now, so I haven't seen, like, this type of inflation, how significant it is. I'm hitting my head against the wall, making phone calls, having conversations like with people like yourself to figure out, okay, like the rising interest rates, is this the only way that they can kind of curb it? Is there anything else that might be coming down the pipeline? Talk about that a little bit.
Oh gosh, you get me going on this stuff.
I know. I follow you on Twitter, my friend, and everyone here should go follow this gentleman on Twitter right now. Open up another tab on your computer and go to Twitter and go follow this gentleman.
The thing that we have to consider is, first and foremost, is we've got to quit listening to mainstream media and the narrative that they're putting out there, because it's just inaccurate. We can call it not true because it's not true. I don't want to get into that part of it, but here's some fundamental things that we have to understand around inflation. Number one, I was a young man in the 70s and 80s, so I came through that inflationary period. When I bought my first house, I was paying 12.5% interest, on that first house. I remember when it dropped below 10%, it was like, wow, holy cow, like this is almost free money. It's like crazy. And when I started investing in real estate, I was paying 6.5%, 7%. And, when I first started investing. So, but the point of all of this, this is back in those days, the boomers were young people. And what were they doing? They were leaving home when they were 17, 18, 19 years old, far different than today. They're moving out. What are they doing? They're buying furniture and, of course, stereos. You'd have a stereo and no couch. Like, it was like you were buying stuff because everybody was setting up and moving out and doing those things. So demand was off the charts. So the only way to bring it into check was to actually increase interest rates. Fundamental difference here, and this is what people don't and they're not talking about, is the demand is not off the charts higher than normal, by the way. It's just not. What's broken down is supply. Is there some slight increases in some areas in demand? Yes. So here's the thing. Interest rates is not going to crush inflation. It will crush demand because people will not have the capital to spend on some of these things. There's a fundamental difference there. So when we have a supply shortage, interest rates doesn't fix the supply chains. It doesn't open up the ports in Shanghai. It doesn't open up the ports in LA. It doesn't get goods moving. We have a fundamental challenge is that interest rates, rising oil, and energy costs are what's driving prices, not excessive demand off the charts.
So is it a matter of opening up the port, like just trying to fix the supply shortage? Is that kind of
the supply's got to start to open up again. And I mean, it's a big topic, but ultimately we're not going to see inflation get in check in a big hurry. There's lots of risks of stagflation, which means, the economy starts to slow down, but inflation continues to carry on. So those are some of the issues that we're going to be dealing with, I believe, going forward. Now, and by the way, there's lots of arguments. Somebody can say, Patrick, you're full of shit. It is demand, and we're going to crush demand. And I'm going, nah, I've done enough research. Let's put it this way. I don't think anybody knows for sure, but we have to create a thesis for ourselves and then make decisions based on that thesis, hedge where we can. But ultimately, inflation is not going to go away in a hurry. Oil is not going to drop out of the bottom. And everybody's saying, well, no, when we get into a recession globally, oil's going to fall. No, guess what? Oil drives the world.
Yep. So I tend to agree with literally everything you said, and I'm going to add just a couple of points. And these are things to watch out for, and maybe take a little bit more seriously the whole repositioning of your portfolio, and or the potential of adding a few doors that you can do a smart purchase during this time that will actually further stabilize your portfolio, because it's a good time to buy. But let me make a couple of points to the inflation comment. Right now, the Bank of Canada is so heavily reliant on inflation coming down that they're trying everything. The interest rate is Jazz asked, is this the only way? And the answer is no, it's not the only way. There's a million stimuluses they can cause. They don't want to. Right now, they just need people to stop spending. That's what they're trying to achieve by in between the cost of food, the cost of fuel, between your higher interest rate. You're going to be forced to. If the government goes too far, now you're going to have a risk of sinking into a depression. And if that were to happen, that is the adverse effect. Because now if a business cannot operate because the cost of operating a business is too high and it has to let go of staff, it's that fine balance of getting inflation under control and keeping the economy moving into a healthy way where people are not spending, but they're working, they're progressing through. That's the perfect world in a recession. You just bring everything down, try to get everybody not buying all the things and not spending all the money, and the money is sitting. If you go into a slight depression, if you go into a deep depression, then it's going to take you 5 to 10 years to recover, like what happened in 89, which up until 97, I never knew. I never lived here. But when I got back, that's when I graduated high school in 97. When I went into university and college and I started learning about economy, I'm a math guy. Like I love data. When I started learning about these things and what had just happened in Canada, it took 10 years to fix.
Yeah.
Toronto, when I moved to Toronto in 2000 to go to Ryerson, 2000, houses worth 275 to 3.25, Jazz. Rates were 6.5%. When we started buying houses, etc., when we got a 5.25, we were celebrating, bro. When we got a 4.99, we thought we robbed the freaking bank.
I got my license in 2004, and so hence when I'm talking about $25,000 parking spots in downtown Toronto, that was to everyone that was really high, but it was the norm. I mean, now it is at 125. Some places are 190, right? Yeah.
But we own a couple of condos that we bought for under 300 downtown Toronto.
Yeah.
So that's unheard of now because they're 700 to 1.5 million for an average condo. But Jazz and I bought at River City 2 for 287 and another one for 299. I have the APSs in my files right behind me, right here. So things change rapidly. It takes a long time to get out of a shitty economic situation. So our politicians, our economic policy, I think people should pay closer attention, because if you're in the real estate investing space, this is how you identify opportunity, by knowing or having a really educated guess to stack the chances for you, not against you. So when Patrick says, like, they're full of shit, well, but I've done enough research to know. Patrick is very confident because he has done enough research to satisfy the overwhelming chance of winning. If he loses, well, everybody can lose.
Yeah.
Like, we don't control the world. But if you can at least have enough knowledge or know the people, reach out to Patrick and the RAIN organization. Take a look at the research available to you. You will not regret it. You're going to come up with 15 aha moments. Oh my God, that's how that works. Oh, sweet Jesus, I didn't know that. This is how you make great decisions.
And I think too, in just because of the business that, when we look at, brokers that are supporting investors or supporting, the more the more you're able to also create great relationships with your client. You become that kind of anchor for those clients that they can rely on, somebody who's grounded in the data, not in the the FOMO or the headlines that are screaming, the sky is falling. And certainly this is a very frightening point of time for many, but it doesn't mean, you can't live in the fear. You got to dig into what's driving that fear, and then how do you, number one, create opportunities from it, or see the opportunities going forward, rather than being reactive, being proactive and making decisions based on that. Something I don't want to step over, Jazz, is, there's a lot of talk about inflation in terms of food, for example. The reality of it is it's not like we're eating more, we're not. The reality of it is there's a huge food shortage that's already starting to occur, and it's going to get far worse. And that may seem like fear mongering, but it is just the truth. It will come and it'll hit us like a wave, and we'll all of a sudden realize that what's going on in Ukraine, what's going on in Russia, what's going on in Europe, what's going on around the world is a breakdown of supply, and food is part of that. So these are things that we have to consider. The cost of, Alberta farmers or Saskatchewan wheat farmers, Alberta beef farmers, the cost of them to combine, to grow crops, to feed cows, to harvest chickens. It's like going through the roof. That's going to add up to severe cost increases to us. So these are things that's not fear mongering. That's just a fact. So you can actually be freaked out about it, or you can put a couple extra cans of food on your shelf, and or be prepared for what could come this way. I mean, the downside of it is if I have an extra couple cans of food on my shelf and it doesn't turn out that way, okay, great, I'll donate it to the food bank in a year from now. But in the meantime, I want to make sure that I'm covered in that regard. And like that, and like real estate, all we're doing is looking at where we have to see what the reality is, and then where the opportunities exist.
God bless my wife. I think she just stacked enough food downstairs in my basement for the next 6 to 7 months. So I'm glad she did that. It was a little bit of a hassle getting everything out of her truck and downstairs, but I'm glad that she did that. Yeah. One thing that we mentioned, and one thing that Rain really is fantastic at, they're essentially, in my opinion, probably the only investment group that does the amount of data. There's other investment groups, they're phenomenal, they're great. The one thing that Rain does really well, and that they've been doing it for a very long time, is the research and the data. And there's one report that I always look forward to, and I would love to just get, in the next 5-6 minutes that we virtually kidnapped you now, coming up to an hour, Patrick, if you can just touch on 2 things. Number one, the report that I'm speaking about that I always look forward to is the next, like the top 5, it could be top 10, I could be wrong, top cities to kind of invest in. We're national, it's REC Canada. We're born and raised, we're very biased to the Toronto market because we're born and raised here. I am, Simos is pretty much born and raised here as well. But we're like nationwide. So talk about those next maybe 2 or 3 cities and why. I think that's very important for people to get an understanding of that. And then the second thing is, please, take this time to educate my guys and gals about all things Rain, and maybe the simplest way that they can get in touch with your team and your group. What's the best thing, the next step, the first step that someone should take just to get into the Rain world, whatever that may be?
Yeah, well, that one's really simple. To get into the Rain world, go to raincanada.com, and all of our stuff, all of our information is there. We're a membership-based business. We're national in scope, been around for 30 years, and really educating first-time, next-time investors, whether you're just starting out or whether you're really accomplished. We kind of play to it all in terms of education, support, the network. I mean, we have members that have been around 20 years. So we really do that. And so that's really, if you want to become a part of a community of like-minded individuals in a culture of support, Rain that's what we do. That's what we're really proud of, and supporting investors to succeed in that regard. And we do lots of research, as that's kind of what drives us. So then that's one aspect of it. Back to Top Town. So back again, everything, all boats were rising on high tide, which it seemed to be the whole world was on a high tide in terms of real estate. It's getting very regional now. Not surprising, of course, what we're seeing with oil prices and where we see the future of oil going. And guess what? The pendulum is swinging back west. We're starting to see, Alberta. We've been talking about Calgary and Edmonton as an example, but even the outlying towns, there's probably a half a dozen great towns to invest in Alberta right now. Edmonton, Calgary being, the two primary cities. You look at Lethbridge, for example, another great city to consider. But there's
big university in Lethbridge, big university.
Yep, exactly.
Great little side economy.
Yep.
It's good. Medicine, how do you feel about Medicine Hat?
What's that?
Medicine Hat.
Yeah, Medicine Hat is great. And fundamentally, what's great about it is the point of entry when you're getting in there in terms of prices is cash flow is going to be very, very strong. It is very strong. And we've been talking about Calgary and Edmonton now, like I say, literally for 2 years. Coming out of the gate with the pandemic, we could see the future there. Believe it or not, you're going to see Regina and Saskatchewan start to do, or Regina and Saskatoon do very well in Saskatchewan again. That's because short of another drought, I guess, but we see oil into Saskatchewan is another, and then agriculture. Guess what's happening? Of course, agriculture, food, fuel, fertilizer. Canada's there to supply it. Western Canada, that's what they do. So we're going to.
I have good friends that have been working in Kimberley, Saskatchewan now on the natural gas side. Yep. Saskatchewan has so much shallow well natural gas. Yep. It's unbelievable, and that's exploding more than ever. So we can expect a big rise in Saskatchewan. I think you're right, Patrick. I think that's fantastic.
Manitoba is going to be kind of that neutral province. There's just not a lot going on in Manitoba, and that's not to make it wrong. It's just that from a growth perspective, it's just not the same as some of the other provinces. British Columbia, you have to be you have to look very closely. Vancouver's will start to always come back to life. The major cities will always, Vancouver, Toronto will continue to do well. You got to be very clear on what it is you're buying and why you're buying. So you look at the condo market in GTA or in Vancouver and surrounding area, they'll continue to do actually quite well. Once again, driven by affordability and the fact that rents will continue to increase. But there's something that I want to say here because of I'm talking about lots of Ontario. Is that don't go buy condos in Edmonton and Calgary. Full stop. Don't buy it. I'm just telling you.
You've been saying this for a very long time. Go in on why. Why do you say this so much? Why is that not a good idea?
Yeah. Okay. So it's simple. Supply demand. There's more supply than they know what to do with. When the builders down there got caught with their kind of pants down around their ankles, guess what they had to do? They took that those sales units and put them into the rental market, and it's just a glut. And a lot of those buildings are now very old. And here's what's happening. Insurance in Alberta on condos and even on older multifamily units, off the charts. It's killing condo boards and associations, stratas, because their insurance has gone up sometimes 500%. It's off the charts. So condo fees that you bought in at and they're $400, now they're $800. Now they're $1,100 a month.
Because you got to carry the whole building.
Yes, exactly. So and at the end of the day, culturally, Alberta is just not meant to live in. They want wide open space. They want backyards, and so. The point of it is, from an investment point of view, you're not going to get a lift. Okay, yeah, you can rent it out. Maybe you can all make it work, but it's just your ROI is going to be crap. If you want to live in one, go crazy. But
look, I think it's most important to invest where the returns are best, right? And so
I can tell you, part of my portfolio, I still have a half a dozen condos in Edmonton that I bought many years ago. And the only thing is I never refinanced them. I don't really owe any money on them anymore. That's the only thing. But I don't know how I'd exit. I probably exit and pay what I bought them for. I don't look at it that way. But the point is
look,
that
at any time, Patrick, you want to write the
exact same with the Red Deer condo. The Red Deer condo.
Sure.
It's worth less than what I bought it for. It's never not been tenanted.
Yeah.
It's never cost me a dime.
Yep.
But it's never done sweet FA for me. Nothing. Ever. So let it be. It'll be paid off. My kids will one day find a couple $100,000 in Alberta. That's
right. Just really briefly, funny story. I've got a condo downtown Edmonton, and it's a great condo. I've had it literally since 2000. Helen moved into it in 2000, and Helen has lived in it since 2000. and she still to this day writes me 4 post-dated checks. It's the only way to pay. She doesn't want to write me a year. No, it's 4 post-dated checks. Forget about e-transfers. I don't even know what that is. And so she mails me 4 post-dated checks every month. And so she's lived in it for 20 years, and basically it's paid.
God bless Helen.
I love Helen. I think she's got to be 86 by now. But anyways,
I love it.
Yeah. So that's what we want to look at. So look at the property type that you're buying, and make sure that you're buying the property type. Who is your tenant profile? And like, what is your client? What's your client base? Who are you actually looking to have as a tenant, and then buy the property that accommodates what your profile that you want it to be. So then as we come across the country, I think in Ontario, you guys know GTA better than anybody. So, that's where your guidance comes into play. And then you look around some of the smaller centers. I've always been a fan of Peterborough. I say always, I have been for about the past 5 years. I still think Peterborough, as much as it's an expensive market, or it's got had a lot of growth in it, I still think lots of opportunities in some place like Peterborough, for example.
And why Peterborough? Is it like that you can get in, like for a home with a couple of doors?
Yep, point of entry. Like, it's the price of entry to get in. Number one. Number two, proximity. This work from home phenomena is not going away. I mean, government is still not back in the office. And I happen to have one of my coaching clients on the personal development side happens to be an auditor for the CRA. In her group, she has a group of 600, and they did a poll of who wants to go back to the office, and 93% said no.
Wow.
So
okay, I didn't think it was that high. I actually thought it was going to be closer to 50-50.
No, in her group. Wow. In her group.
Got it. Yeah.
So the point of that is that people want to work from home. They don't want to be in this, in the congestion of the city. They don't want to commute. And now more than ever, the argument is, I can't afford to commute. And if they have to commute, of course, that's when we're going to see wages start to rise, because people need to make more money. And then the cost of business is going to go up, and on and on and on. Those are the kinds of things that happen. But Peterborough is popular. It's a great little city. It's close. The proximity to Toronto, is right there. And that's why you're going to see popularity there.
Okay, awesome.
I'm a huge fan of Hamilton, bro.
Yeah.
Hamilton right now I've literally done, we at the REC have been very bullish on Hamilton for the last year. Yeah. My outlook on Hamilton continues to be ridiculously good, meaning I'm extremely, I have personally met with Hamilton's mayor and a few of the councillors that are responsible for development, and we met on site at one of the developments we're working on for the ground break, and it was a very exciting time. The government, between federal, municipal, and provincial, have already invested $4 billion plus into the GO trains, LRTs, port redevelopment, infrastructure projects across hospital, McMaster, all the things that can make. So Hamilton has grown 250% in 13 years.
Yeah.
For everybody just to understand, this isn't news. Investors have been pillaging Hamilton for the last 15 years, including us, Jazz, myself, maybe Patrick. I'm not sure if you're in there.
Well, just to your point, I mean, Rain was talking about investing in Hamilton 15 years ago when everybody we were nuts, right? And so I want to point something out, just sorry to interrupt, because it's so important. You said it with Hamilton. In any of these cities, in any of these smaller centers, for example, economic development and the economic development office, if they're not progressive, stay the hell away. But what you've got in Hamilton is you've got an economic development office and a mayor who is being progressive. They're going, how can we build the city so more people move into the city? How do we become an economic hub that can make a difference? And this is so important. And the reason I say that is because if you look at Barrie, I can use Barrie for example. At one point, Barrie was very, very progressive with their economic development. And now in the past couple of years, it's going sideways, and you start to see the effects of that. So there's two comparisons there that you can make. So yes, I'm very bullish on Hamilton as well.
It actually took Hamilton a very long time, in my opinion, because Hamilton was like the next up and coming city to invest in a decade ago. To your point, Rain was thinking about it 15 years ago. I heard it and saw it 10 years ago, but I don't think there was the mayor and the federal. Once you get all three levels of government pumping in,
but what has been completed,
boys,
what has been completed in the last 10 years, though, is that GO train expansion that saw markets like Niagara, St. Catharines, Grimsby double and triple in their values because of the infrastructure. So people need to understand, when they've spent $4 billion and the only thing they will be doing for the next 10 years is spending another that much, this is where you more than likely want to go. With that said, I didn't set up this whole thing for fun. In 10 days from today, the REC is going to have absolute first access into a project in Hamilton. We're going to try to get all the information out as soon as possible. Again, pending there's no delays because of supply chain, government being behind. It can be pushed into the fall very easily, like it's happened to us before.
Yeah,
but Jazz in terms
of that, like we still have people that that I know are online that are actually in contract with
exactly.
a lot of projects, and so it might not be in 10 days, just so you know.
But Jazz, you will be presenting that. You're going to be putting that forward. I'm just saying there is opportunities, just like we presented 4 opportunities in Hamilton in the last year. We are continuing to dig and negotiate, of course, with our development partners for the best incentives. So just stay tuned. Jazz has the pulse of our audience at all times. You get our emails, you get our updates. And of course, when we bring people like Patrick on the show and he says, Peterborough, well, guess what my move is on Monday morning? I'm going to go do a little dig, see if I see something interesting. That is, of course, able to get 20, 30, 40 of our insiders in. Anyways, I'm going to leave it at that. I know we've kidnapped Patrick a lot. Jazzy, is there anything you wanted to cover? Do you want me to get the stats out via email maybe?
So what all I really wanted to quickly say in terms of all the cities that Patrick mentioned, if you're looking to actually wanting to speak with experts in that area, just send Tyler an email. You guys know where to send him an email. It's info@reccanada.com. Don't make it all formal. We don't need any of that. Just put it in the subject line and just say Alberta Realtor or whatever it may be. We'll put you in touch with somebody that's savvy when it comes to investing into real estate in those cities. And if you know someone, great. We don't want to step on anyone's toes and in terms of relationships. But if you guys are not yet have gone to either follow Patrick on Twitter and or gone to raincanada.com. I don't know what the heck you're doing. Make sure to go to those 2 places, because I truly believe that Patrick, you do a phenomenal job speaking directly to people. And you know what it is that I really enjoy about you, brother, is that you kind of dumb it down and speak in layman's terms. And because some of these GDPs, the inflations and the recessions and all these words, people hear them, but they really don't know what the heck it means. But you have a way to really break it down. And so, I want to thank you for bringing that experience and knowledge to our REC insiders, and from a selfish perspective, allowing me to take some of the stuff that you say and use it in my own words, and then I go do more due diligence on it or more research on it and bring it to my conversations. But
so Jazz, I think that is our duty, is to transfer good insight. This is why we do this. We're not, nobody knows everything, and you have to know that. You have to know that every day is a learning opportunity. Today, I learned something from Jazz and I learned something from Patrick. All of us learn from each other. So when Jazz says he's going to pass that along, I know he's going to be screaming it from the rafters for the next 30 days, all these little nuggets.
Oh, Patrick's going to see an Instagram video. He's going to see an Instagram video about something that he said today that I'm going to use first thing tomorrow morning. Or later
a million %. But that's you as an influencer, Jazz. It's your duty to do that.
Yeah. Well, Patrick, any one parting tip for our guys and gals? You're amazing. Thank you so much. I mean, obviously, you can see that the bromance between all 3 of us is growing to the next level. So we thank you for that. But one parting tip maybe for our investors out there.
Well, ultimately what happens in these scenarios of what's happening economically is we can sometimes pull back and then we become very insular and we're not putting ourselves out there. So I would encourage anybody who's feeling that fear is actually, this is the time to immerse yourself with like-minded individuals, understand the professionals. You know, that's why we love REC as well, because you guys know what you're doing. You're in the trenches, you're looking at data, you're not just hyping a product, you're actually making, you know, you're doing the research to actually know that, no, this works. It's why you're as successful as you are. So hang out in a like-minded community, a culture of support, you know, where people aren't going, oh, I'm not going to share my secrets. It's not about that. It's really about wrapping your arms around each other through a challenging and kind of fearful time, but don't let it stop you. You know, get into that community and have these conversations.
All right, guys, to the REC Nation, here in Ontario, it's shaping up to be a beautiful, beautiful day. I hope wherever you're watching from, it's the same. As always, please take a moment of gratitude and just thank you. Thank anybody around you that you haven't maybe spoken to. Reach out to someone, say hi, see what they might need. And if you don't have anyone to reach out to us. And we don't need you to be doing a deal or anything of that sort. If you just need a second set of eyes on a lease agreement, you need a plumber, you need an electrician. It could be anywhere in Saskatchewan, right up to Toronto, wherever you are. We're more than happy to do that. It doesn't cost you a penny. For anybody who's new, who's watching right now, we have a real estate concierge service that does not cost you a penny. We will put you in touch with people right across the country. That's my parting words. Have a fantastic day.
Thanks, guys. It was fun.
Take care, Patrick.
Patrick, Jazz.